Hello, I'm Jay Hirsch, Director of Administration of Columbia's ERM program. Welcome to tonight's event, our Author Spotlight, featuring part-time lecturer Chris Droussiotis, author of the Credit Analyst Survival Manual. Throughout the event, please post any questions you have using the Q&A feature at the bottom of the screen. Questions will be answered at the end of the event. And now here are moderator Bob Kostakopoulos and Chris Droussiotis.
Okay, well, thanks for being here. I'm very excited to be here. Bob Kostakopoulos, Deputy Program Director. I've known Chris for quite some time. We teach in the same program. And I'm excited about this because his book that he's going to be discussing today is a book that addresses many topics focused on credit analysis as well as credit risk management. But not only that, he is quite broad. And what I like about the book and why I'm excited to be here is the topics that he's talking about are topics that I grappled with all my professional life. Credit risk is an immense risk, pervasive. It affects all industries, whether financial or non-financial, government, non-government, you just name it. Every one of those entities is subject to credit risk. Some of them know it, some don't. So that sets the frame that credit risk analysis and credit risk management are very important topics, right? So, Chris, I would like you to introduce yourself to our digital and in-person audience. Please go ahead.
Yeah, so I was just like you, actually, at the school when I got a call from Bank of America that I'm hired. So I went in, it was on October 7th, 1987. Now, October 1987, for you to know, we had the biggest crash in the stock market. It's called 504 points, I remember. And I was, as a young analyst, I didn't know what's going on. They closed doors. So I went around and said, do I have a job? But that was my introduction to the banking. Like right into a banking crisis, I started. So I moved I was at Bank of America in the leverage finance business. And if you read anything in the late 80s, it was a plethora of leverage buyouts. And one of the biggest deals that worked, it was the Arjun Nabisco. If you read the book Barbarians at the Gate, they made a movie out of it. I was part of that whole era of raising a lot of debt to buy companies by many private equity. So that was my introduction to, so fast forward, I spent about 30 years in banking in various major money center banks, Bank of America, Merrill Lynch. I was at CIBC for the Canadian Bank, and I spent last 20 years working for Japanese banks. Before I officially left the banking to start my own business with 3 others, basically we started a venture capital looking at different perspectives on credit, financing brand new startups in a seed, pre-seed, pre-commercialization. So and I'm doing that for a living. Plus I've been teaching at Columbia University as a part-time lecturer for the last 5-6 years, teaching the introduction to finance classes and teaching 2 other classes and writing books. So that's kind of the story here. And hopefully out of this event and many more events like this, you can get something out of it. You can get inspired to start your career. It is credit risk or financial risk management, or any enterprise risk management area.
That's great. Great introduction. Thank you. So, Chris, tell us about your background in credit risk management.
Yeah, so as I mentioned, in the banking business, the way we break up, and it's actually break up the banking into a relationship banking and to a high yield banking. Let me explain. Banks, traditional banks, of course, things changed a lot since my days. Traditional banks were there to serve the customers for many products that the bank offer, from project finance, leasing, helping them with cash management, many things. So that's the relationship banking. But the bank would take some risks and say, okay, I'm gonna take 10% of my, out of my investments, and I'm gonna do something a little more risky. And the risky part of the bank is all the left fin, the leverage finance. So my background is in the riskier part of the bank, doing left fin, basically financing leverage buyouts where a private equity is buying a company and the banks provide the debt financing. So any LBOs, you have the equity and then you have the debt. And so we did that business for many years in many areas of capacity. So because of that, it's very credit intensive work doing leverage buyouts because, of course, by definition, you're giving a lot of debt on those companies. And once you write a check and give the money, you want it back right away. So basically, the monitoring of the credit is one of the most intense credit analysis because you're lending a lot of money to a riskier customer than usual. So there is a lot of credit intensity. So throughout the years, credit analysis is a must. You have to hire the right people, the right mindset of making the analysis. So that's why I got me into the credit risk management and finding ways to, measure the risk and protect any situations the bank might arise.
The major players from those times, like KKR,
Exactly.
right? They're still around and they're still doing well.
Doing well. Yeah.
So over the last 3 decades that you've been actively involved in credit risk management, what have been the biggest innovations or challenges?
Big change. So if you look at a deal in 1988, and you look at what the banks involved, it's a totally different than in today deals. First of all, 1988, if you look at the Argent Nabisco, which is the largest deal back in the day, 31 billion, 60% of financing came from Japanese banks, and they were holding a big exposure. Now, fast forward in the 2000s, after the Japanese went into the decade of recession in the 90s, we lost the ability to syndicate, which means sell the loans to other smaller banks. So that was the birth of the CLO market, which is a collateral loan obligation. It's basically funds by private investors that we have today. And you heard about private credit today. So the CLO market took place in buying those loans in the secondary. So what has changed over the years, if you look at the list of the banks of any major transaction, KKR, Apollo, Blackstone, 70–80%, the companies you never heard of. It's like all these private credit guys that buying small pieces, $50, $100 million pieces, because I think I mentioned this. Most of the large LBOs, let's say JP Morgan will commit, let's say, 10 billion in a deal. Of course, JP Morgan cannot hold 10 billion in their books. So they had to sell their position to other smaller banks. In this case, they sell it to all these funds. So the composition of the syndication has changed a lot over the years. And as the banks are trying to unload the risk from their books. Yeah.
So lessons learned.
Yes.
I'm sure are many, right? But what are some of the lessons learned that are not commonly discussed in the literature?
Yeah. So the government, in a few occasions, we have few crises, like anything, go through a recession or crisis. So the government trying to find ways to give guidance to banks, how they would conduct risky business. And the guidance is not perfect because one guidance they said, well, I don't want you to do a deal more than 6 times EBITDA. Let me explain. Your debt of the company has to be about 6 times the profit of the company. Anything more than that, we're going to view that as very negative because, of course, so the debt capacity, call it, how much companies can take, originally it was guided by the government. So companies like us, they said, well, if KKR wants to buy a company and pay 15 times multiple, they couldn't really bring a multiple of debt above 6 because we're guided. But lessons learned, a 6 times leverage, I call it, debt to EBITDA, might work for one industry, but it doesn't work for another industry. This they don't teach you. They go by because the market it's a market-driven leverage instead of credit-driven. Okay, if I'm a utility company with a very stable cash flow, I could do 6 times, 7 times cash flow because I'm going to get paid over 7, 8 years. But if I want to take a cyclical business like an auto supplier or housing, depending on housing cycles, you can't really do any 3 times cash flow because the EBITDA is going to drop and you're going to have a problem. So lessons learned, each industry, it has to be viewed differently. Now, S&P and Moody's, which they are in the business of rating, they do have industry adjusters, if you will. So they became a little better in monitoring some of that from the experience they have. And now with the AI and everything else, with all the data of what causes the bankruptcy and everything else, so now they become a little better in actually rating which one is riskier versus another, instead of getting to a one number.
So basically, you're alluding to it's not just the cash flows that you need to worry about, but also the volatility of the cash flow.
Exactly.
Right.
Yes.
All right. So now, in terms of technology, right? Technology has made, changed all industries.
True.
And disciplines, right?
Yes.
How has it affected credit risk management over the years that you've been active?
Yeah. So what happens actually before the discipline, banks, they are viewed as self-discipline, right? Because let's say I don't want to do too much of this, so but it was all gut feeling. It was like you had managers with a lot of experience that's seen many cycles that they will look to them to make a decision. Either we're going to provide credit, but over the years, now you have the rating systems. Each bank has a rating system, and what I mean by that is that when you take a company and you throw in all the ratio data into the system will come back and give you, a risk profile of the company. So either to guide you how you're going to price it, or tell you how much debt they can hold. So that the system internally became even better because, like any AI, the more data you feed the system and the more data experience, the better it becomes in making a decision or helping you doing that. So it's a lot of the systems have changed over the times that helps the banks a little better than previously, that the banks took a lot of gut feeling, and a lot of banks got hurt during the crisis because it's all about you getting paid bonuses and I have to do more deals. I have to compete with other bank. I don't care if I want to take a little credit risk because I want to get the next deal. Now it's a little more disciplined. The system tells you, no, you can't really do that. Doesn't matter. So I think that changed a little bit the profile of the.
That's a segue to the next question.
Yes, exactly.
That has to do with regulatory changes that
Yes.
have impacted credit risk management. Can you speak to that?
Yes. So the government actually, back in the 1980s, we had a after this whole crisis, we had actually in 91 was the big crisis. We had the first crisis of the bank. The government says they start categorizing this type of deals, the LBOs, HLT, high leverage transactions, I remember. And basically, it says, well, you can't take too much exposure on those companies. So what the banks did, they said, okay, I'm going to unload the exposure. I'm going to create a syndication that I don't have to hold all these banks, and I'm going to sell these loans to others. But what happened actually, it was they created a systemic risk because the companies, the banks that were buying those pieces, they were financing indirectly by the same banks. So it's almost like you're unloading the risk to someone else, and that someone else actually you're banking that someone else, so it affects. So the regulation, the second time around in 2008, financial crisis in 9 and 10, they try to say, okay, we need to capture the systemic risk now, not just the exposure of the bank itself, because by unloading the loan is not less risky because you're giving it to someone else that you depend on them. So that's the regulation change. They try to focus more on the market risk that the credit risk will impact than just purely credit, right? So.
Yes. You discuss market risk in one of the chapters. So now, in terms of the you alluded to the 1980,
Yeah.
1987
Yes.
crisis, but other major events, right, that have impacted, the practice of credit risk management. What are they?
Yeah, so there's many, what happens, I just found out throughout my career in banking, a crisis, any crisis, creates an invention, again, for a new product, a new area the banks have to do it. So the 1990s, of course, with the Japanese being the biggest buyer of the US bank loans in the HLT market, they went away. So how do I continue to do deals? So what it is, we have the CLOs, the impact of the new CLOs coming in. So the CLOs would take these pieces. And then we had the 2008 crisis, the 2009 crisis. Of course, you have a few mini crises in between. We got the 91 bubble of the dot-com, which has some exposure that had to roll over to other businesses. And then we had the 2001 9/11 that impact many of the companies. And then in 2008, of course, we had the major financial crisis that impacted by the bank. So every step of the way, it created another way of the banks to actually self-discipline the risk. So all this crisis created something. So the biggest thing these days is the private credit, which is provided by many institutions, even private equity institutions like Carlyle, KKR, Blackstone has one of the biggest private credit events. So my point is that a recession, it almost makes you, it makes you want to rethink the model. And every time I remember, because I was in the leveraged finance business for many years, every time was a crisis, I think, okay, that's the end of the left fin business. But then it recreated much bigger now. Today, this year, they're going to have one of the biggest issuance of high yield bonds and also leveraged finance. So you always think that the banks are going to get out of it because it's too risky, but it's another way they get back in, they're disciplined, they become a little more organized, and we're back into the business. Yeah,
exactly. So private credit, right, as opposed to private equity. Private equity is more familiar, but now Chris is talking about private credit, which is debt-driven, right? Okay, so how important, in your experience, is for credit analysts or credit risk managers to develop soft skills and relationships with stakeholders, clients, and so forth?
Yeah, so it's a very competitive market. Banks, it's a big, especially in the business of, in the yield business, I told you, the relationship banking is different, but in the yield space, which a lot of banks make a lot of fees in the leveraged buyout. The leveraged buyout includes many parties. You have the private equity providing the credit. You go to JP Morgan to provide the debt financing, the bond financing, and you go to the banks to provide the loan. So there's a lot of competition in taking the next deal. So of course, because of that, you have a lot of interaction. Your client interaction is very important. And if you show up in the business that you are very credit driven, you understand what you do, you can get back to the client within a reasonable time with the best deal, with a big structure, I think you're ahead of the game. Versus, and I had a problem actually working for the Japanese banks. Japanese banks in general is a consensus-driven decision-making, where I was competing with Goldman Sachs, with one guy makes a decision, the managing director directly talks to the customer, he's a decision maker. Where what I was doing, I was talking to the customer, can you do this? Well, let me get back to you. I got to talk to about 10 other Japanese managers. So that was a disadvantage for many ways, because the client wants immediately, he wants consistency, speed, and ideas. Those are the three things the customer wants. So in your credit career, of course, it's not like, don't think about credit analysts sitting in the corner doing computer work. It's actually learning a discipline that you can go in front of the client and give ideas. This is what we're going to do. We're going to structure it this way. We're going to structure it that way. I think if we do it this way, you're actually discussing their return analysis too. You get involved in the minds of the investor because the investor will come to you because you already have the product for them. So it's a lot of important for soft skills, be able to discuss the customer what they want to hear. And that's important in these days. Yeah.
That's great. Now, in terms of projects that are seared into your memory, right? In terms of illustrating the challenges and complexities of credit risk management, can you address that?
Yeah, so as I mentioned before, we're going through many cycles in banking, and there's always reinvention of credit risk, how we apply for that. And as I mentioned, one of the biggest deals that I did back in 1980s was the Argent Pisco. They made a movie out of it. It's the Barbarians at the Gate. And then after that, we had no many mega deals. And until back in the late 2000s, when the CLO market came in, and there was someone that can buy this credit, the biggest deal was by KKR, is TXU, which is a Texas utility company. So a lot of companies back in the late 2000s, before the crisis, 2005 and 6, they start back to the mega deals. There were many mega deals. But the complexities got even more, because let's think about a deal. How many parties you have to satisfy? First of all, in an acquisition, you have to satisfy the seller. The seller wants more money, but if he needs more money, the buyer is not going to make his return. So he's trying to discipline to get the price down. And then you have the banks that there's so much debt I can give you. I don't care if you want to pay so much for the company, that differential has to come from the equity. So you have this complexity of three satisfying on a deal. And that makes actually credit analysts more inventive to get the deal done. And the invention of many ways. Okay, maybe we can go to the bond market now and bring another asset class that can meet that risk gap. And so there's a lot of complexities in structuring all this, having all these parties agree to a deal. And that's probably the most beautiful thing about credit. It's never boring. It's never the same thing. It's always find ideas to get the deal done, and discipline enough not to put in too much risk into the system. Yep.
That's great. So now we have some questions about the book. And the question is, what motivated you to focus on credit risk as the subject of your book, the main subject, because you have many different subjects there.
So, of course, I work for a bank, and I will be the hiring manager of many of you. And basically, what I was looking for is to someone really that has critical. They take the information and they have a more critical thinking. I always tell my mentees here that we're not testing you about the knowledge of something, because they're going to train you anyway. It's testing you once you get the information. How do you do the analysis? So I was very inspired how credit analysis is different than investment analysis. When you invest in a company buying Tesla stock, you hopefully the stock goes up and you sell it down the future. Company does earnings, they have profits. When you do credit investing, you don't really care if the company does well or really well. I mean, you want the company to do well, but really well versus well, it doesn't change. You want to get your money back. So the analysis is getting your money back. I'm going to give you money and I want it back in 7 years plus interest. So the analysis is different. It's more like a defensive analysis. I mean, you give the money and you say, okay, can I have it back, I guess. So my point is that I got inspired by that thinking. And I said, okay, let's dive into what pays you back. Strength of cash flows as a primary market, strength of assets the company has a secondary. So now I started trying to teach young analysts to get that frame of mind. So I started training programs. I was at the Mizuho training. I started a training program there for the analyst and at SMBC. And they would inspire me, all my notes and my case studies, I was putting it together, training them. I said, let me put it together and make a book out of it. And that's why it started the manual. I call it the manual, survival manual, which I can discuss it, is because it has everything you need about the banking products, for a young analyst to go through a reference and see how everything is structured. And that's basically where I started.
Yeah, and indeed, the book does that. A pivotal moment in your career that influenced the contents. You talk about many different things.
Yes.
So what triggered all of that?
Well, so you actually live through case studies, actual actual cases. As I mentioned, I was involved with the Time Warner, okay? So that's, you go in and just see how it's structured. And then you have many transactions after that, the Blackstone buying Hilton hotels. So you get so many cases and different types of credit risk profiles that I said, I want to get all this information and find out, okay, investing and lending money to a hotel is different than lending money to a cable company. So most of the book goes into industry disciplines, what kind of parameters you use, what kind of leverage you use for different industries, and those are the things. So it's basically all these experiences you have through banking in putting in one book, I guess, under 300 pages. So the book actually has a lot of that discussion of real world case studies and how we dealt with them at the time. It even goes into bankruptcy companies coming out of bankruptcy, which is a whole to recovery analysis. So it goes beyond pre-acquisition, post-acquisition, even bankruptcy in distress and coming out of it. I do have a discussion about airlines that went to bankruptcy and how we dealt with the bankruptcy situation in airlines, and we came out of it. And of course, many of the airlines that you see today, they went through 1 or 2 bankruptcies before. So coming out of it is the biggest key here.
And a lot of mergers.
And a lot of mergers too.
Yes,
yeah.
yes. So what do you see as the common mistakes that credit analysts, young or new credit analysts make, and how should they be guided to avoid them?
So when I get the credit analyst to work for a bank, I wanted the way I approach. If let's say I want to hire you to be a dishwasher, say I have a restaurant and you're going to be my dishwasher person. You're going to wash dishes. Well, I tell the guy, if you clean the kitchen too, even though I didn't ask you, that's even a plus. So as a credit analyst, I want my analyst to not just to be doing credit analysis, but looking at the big picture, looking at the market overall, understanding how how companies actually create cash flow. What are the asset coverage? So go beyond that, the mundane work of a credit analyst, which you have to do that anyway as a young analyst, rating the system. So the common mistakes is that people stick to the small picture and it says, what am I doing here? Am I helping anyone? But you are helping. You are helping because you are managing the risk of the bank. So knowing more what you do in a bigger picture, I think that's the one thing I wanted to discuss. Most of the companies that got, most of the analysts that got moved up and became managing directors these days is because they had that big picture thinking. And the big picture is very important. Yeah.
That's very good advice, actually, yes. In terms of skills and competencies, what are we looking at here?
So I was going to the Excel. Now, I know that there's so many languages now that you can learn that people try to avoid Excel, but at the end of the day, even though we move into, each bank have their own system and you plug in the numbers and it gives you, to me, financial modeling on my own teaches you how everything works. By having a blank Excel sheet and building something out of it, actually teaches you more than the actual Excel. It teaches you how everything changes. So I remember when I first started at the banking, I had this mentor of mine, and he grabbed me, he put me in a room, he closed the door and gave me the financial statements of a company. Here's a balance sheet, here's an income statement. Tell me about the company. I said, well, okay. So I got to start studying. And so the key here, and I'm telling this to all my students, when you are asked to assess something, to value something, to value the performance of a company, just to be honest, you look at 3 things, basically. Those are the three things. And I want you to write those three things because these are three things you want to tell when you're interviewing. The first, which is very straightforward, when you look at something, you want to compare like a trend analysis. So if I look at a company, 5% growth, what does that mean? Let's look at 5-6 years. So you have this projected, if the company is projecting 5% a year, then maybe it's going to continue. If the company is going up and down, maybe that's what they're going to be doing. So trend analysis is the number one thing in credit risk analysis. The second one is to compare with the peers. So you do a peer analysis. So if I said to you, Tesla is up 15%, it sounds good, but compared to the industry, it's much better. So basically, it gives you another perspective. Okay. And the third one is the expectation. Of course, we always have an expectation in mind. Either we disappoint on expectation or not. So those are the three things. So the analyst, whoever is going to be there, credit analyst, always think that way. Always think that if you ask to do an analysis on a company, you look at the performance from a historical perspective, a performance versus the industry, versus the standard, versus the market, or some kind of a benchmark. And then the third thing you do is expectation. And if you have those three all the time in your mind, you'll be the perfect analyst we're looking for. Okay. And that's what I advise you on that too.
Okay, that's great advice. In terms of resources and tools for credit analysts to keep fresh, keep up with the times,
yes,
the innovations and so forth, what are we?
So, you know, it sounds like a very straightforward, but big picture, knowing different markets, knowing how the debt markets are performing, knowing how the equity markets, everything is related, by the way, knowing the credit markets, just knowing and knowledge, what's the next deal? You always have to just call, there's so many resources, there's M&A resources, knowing about what deals are out there. And then working, just actually sitting down with someone discussing the hostile takeover by JetBlue over Spirit Air. That's a good conversation to have. So knowing a lot more, reading about all the different mergers and acquisitions that happens out there, that's a good start. And then you can dive into a little more resources in terms of there's a credit resources out there, credit markets that you can read. And if I have a website actually, which is a private website, you can go in and there's a lot of resources that can get and learn what are the next deals. I mean, there's a pitch book, which is the one that shows all the private equity deals announced and what are the deals associated, which banks are involved. Just have the general understanding and be able to discuss that with anyone. It makes you a little better, better analyst, I guess. So that's kind of the resources I'm looking for here.
So that's a segue to the question about understanding the economic environment.
Exactly. Understanding what drives companies.
So you gotta be curious. You have to learn how things are interrelated.
Yes.
And how they affect you and your clients and that sort of thing.
Yeah.
So in terms of some topics in credit risk management that are overlooked, are there any?
So because now we're moving into some other areas of credit management, credit risk management also touches many other areas. So you would never think that credit risk, you think credit risk is on its own. Market risk, for example, it's actually very related in a sense that the banks, of course, the banks lend money, right? And they lend money, but because those deals are very large deals, they're taking those loans and syndicate them. So the loan itself, wow, I have a lot of people come. So the loan itself becomes like a secondary trading now. And the secondary trading is a whole new fascinating area that is good to know. So you have market risk. And then let's look at some other areas. A bank has the so-called credit review area. This is a great area that basically that you should look into it. It's basically is the second line of defense or sometimes third line of defense, checking the front office if they're doing their credit analysis correctly. And then you have another area, of course, is the portfolio risk of the bank. The bank, if you think about it, a bank actually lends money, and they have to have a discipline of a portfolio exposure in terms of industry exposure, company exposure. So you have another area testing on the risk. And then you have the profit center that if you do a deal, you meet some certain RAROC, they call it, risk-adjusted return on capital. You have a new area of risk. So whatever you get involved, it touches many areas: the market risk, the credit risk, operational risk. Operational risk is the KYC compliance that you extend credit to companies that you want to know who they are, right? There's a whole know your customer concept. So you are in a best position ERM that touches many of those areas within the bank. So whatever you are destined to do, there is always related. So you can jump from one to the next easier, I guess, that if you had to work for, let's say, equity research or something, which is more like investment banking. So the banks has many things to offer within the credit spectrum of risk. Yeah.
So those skills are transferable, in other words, right? As you move to different careers. Now, let me ask you this about the balance of the credit analyst or credit risk manager, right? The balance of quantitative tools versus qualitative approaches, right? How does a credit analyst manage to do an analysis that incorporates the optimum balance of quantitative as well as qualitative data, like governance, like culture?
Yes.
Composition.
So if you take a manual out of the Standard & Poor's credit risk analysis, because Standard & Poor's and Moody's and Fitch and a few other agencies, their job is to look at a company, look at the debt the company is going to raise, and calculate the probability of default. What is the probability that the company is not going to pay back? So they do a lot of quantitative analysis. And they look at 5 things, and I can get into them. But basically, the 5 things is all related to, can this company able to pay me back? That's kind of the analysis, right? But the qualitative side of it is also as important. For example, our bank, all the banks that we had, once you master the quantitative risk, once it's okay, according to our quantitative analysis, given the leverage, given the asset coverage they have, collateral, all this stuff, they should be rated some rating, let's say single B+. So therefore, the pricing for that risk, let's say, is SOFR plus 4%. Perfect. But that's not enough. So now let's look at the qualitative. Qualitative is management. Who are these guys? Who are we banking? Who are the investors behind it? Is it KKR, Blackstone? Have they actually, in a bankruptcy, have they came through and supported their transaction? So these are qualitative questions. If you have many bad actors out there that do business and then they don't, so we need to make sure that the qualitative touches the quantitative. And then you look at basically the industry itself, the company, the outlook of the industry. You don't really know that in the quantitative approach. You might qualitative. Is this the business that we want to be in? Is the technology company, for example, how long is the product cycle? Those things are not, they don't really come into the quantitative per se, though you can put technology and it does some kind of adjustments, but those are the things that are very important. And the more skills you build on the qualitative, the more actually you can do well in the bank, because now you become an expert in many industry concentrations of that nature. Yeah.
Yeah, absolutely. And it's also a competition is very important, right? Because a company will do well if they're not disturbed or undermined by a competitor.
True.
Right.
Market share, who they are. Will I be banking a number 4 person? Well, maybe. So it's all this saying important. Those are very good points that you raised, Bob. Thank you. Yeah.
So in terms of now we're moving to talk about the contents of the book, right? So first, starting with the name. I know you alluded to
Yes.
why you use
Yeah.
that name, but
Right.
if you can elaborate.
Yeah,
you know.
definitely. So what happens, I wrote about 3 books. The first book I wrote years ago, it was more like investment analysis. Investment, I look at the finance overall into 3 major areas. I'm not talking about wealth management because it covers a lot. It's basically institutional investment analysis. Investment is the working for an investment bank and doing advisory for equity investment, bond investing. And then finance, investment, finance, and credit. Finance is more like the corporate finance side, the CFO decisions every day in making 4 or 5 decisions. And then we have the credit side. So when I wrote the book, the first one, which covers everything, and now is used at Fordham University's MBA for non-finance, a lot of attention was on the credit side, because everybody knows about portfolio management and Sharpe ratios and CAPM and all this stuff. And I wrote about this. So everybody's focused on the credit side because it was new. Nobody actually wrote anything in the credit investment. So that inspired me to start my credit book. It's like 650 page. This is actually a textbook. If I dropped it on my toe now, it's going to break. So this thing was too big, too expensive. It's used in various universities in the commercial banking and credit. And I say, okay, this is very academic because I have a lot of professors vented. You have to put this, you have to go through the pedagogical way to discuss it. And I say, okay, I need to put a training book, make it cheap enough, like $50. I try to get it below so they can say to the trading. And actually what's interesting, MUFG bought about 600 points of those and is using in the credit department for as a training.
Good.
So inspire me, and I called it the survival manual because it's geared towards you in understanding concepts, understanding how do you structure a lease, corporate lease, how do you structure a project finance, how do you do a leverage buyout. And what's interesting in the book, maybe the ones you guys have, there is a QR code here. See that? The QR code, you can download 47 templates modeling. Either do a merger acquisitions, leverage buyout, a project finance deal, airline financing, which is all leasing, a project of an energy company. So it gives you, it disciplines you to understand different businesses. So I wanted to do something and give it back what I've been doing for many years. So that's why I call it survival manual, because it has everything you need to know to survive in a bank with all the acronyms and all the stuff that goes in the bank from a disciplined view of institutional. It's mostly institutional. You won't find any real estate here. Real estate is a whole new concept, but at least on the institutional corporate finance side of it, it is a good book. It's called The Practitioner's Guide to Active Credit Risk Management. And the reason it's active because you have, there's 47 case studies here. It's all case study driven manual. So you can do your own templates. You can do the Excel and you show up at your boss at the bank and says, look, I can do the leverage buyout modeling because I have this model that I can build it, okay? So that's what what this book actually gives you. It's true. For dummies, right? They have all this great honesty, exactly. I always wanted something like that on my desk. Of course, now you have access to emails, but back in the days, we didn't have any internet. We just had a reference books. We had the finance reference book.
Right.
We had the law reference book, right? And just put it up. And
The regulations.
Yeah,
all the
regulations.
right?
So that's kind of the concept.
You use the Home Suites INC case
Yes.
a lot.
Yes. So what
I know
did,
it's an important case, but explain why.
yeah. So if you read this, this is what I was thinking. Actually, I had one of my analysts help me at the bank do it. So what I did throughout the book, most of the chapters, I zero in on one company. It's a made up company, of course. Actually, it's a company that I made up. And what is interesting, because you start reading about this company, Home Suites. Home Suites is a hotel company that have an extended stay, nature. People
Like Hilton.
like Hilton, like
has a
Embassy
company
Suites or
like
something.
that, right?
So I created this company. It's a big company. It's $3 billion. It's my own creation, I guess. So throughout the chapters, we go through analyzing this company. And I just say, actually, if you go to chapter 5, it says private LBO, KKR, like I said, but I have other names, super. I think the private equity I use there is called a Super Inv or something. Super Inv called Mia Williams from the bank, ready to do the deal. Mia approached her boss, and I'm going through a real life experience through the banking, what happens. And it goes through, almost like so the first thing you do this so-called screening memo. You get all the information from the client. This is what I want to do. I want to buy this company, blah, blah, all that kind of thing. And then you do a little more research. So throughout the chapters, in the back of the chapter, after I discuss the concepts, the content of it, almost like a lecture, I go into the case study and I stay with the same company because it has a continuous story how they approach it, because you're going to do the financial modeling on the company, which I give you the template. Then you go do a sensitivity case. What happens if it's a recession? So it gives you the ability to do a sensitivity. And then it teaches how to do a write-up, a credit write-up, a full credit write-up, how to do a term sheet of a deal. So I use that, instead of jumping from one case to the next. I wanted them to get familiar with the case, really familiar, the industry, the market share they have, how big is the market. And then he take them step by step based on the content all the way to the end of the book using the same approach. Yeah.
So that's a great learning tool, right?
Exactly.
Because it's a made-up case, but it's realistic. Okay, so I know you alluded to the financial models, and there are about 47 of them.
Yes.
Right? What are some
titles? So for example, in a leverage buyout model, if you have done leverage buyout financing, it has a lot of elements of capital markets, because in a leverage buyout, you have many financial institutions involved. You have the private equity, like KKR, doing the equity. Then you have the bond market, which is called the high yield market. And then you have the loan market. So those are kind of three sources. Within the loan market, you have different areas of the loan. So one financial model is to just so you can structure a traditional leverage buyout. A traditional leverage buyout is based on debt capacity. 3 times debt to EBITDA is the bank debt. The bond can do another 3 times turn. And then the equity is the 6 times versus the acquisition term. So that's what these models help you build some kind of structure. And then you have the mergers and acquisition model, which one company buys another company. So there's a lot of accounting involved because you have the balance sheet of one company and the balance sheet of another. You combine them and you put the new debt structure, if it's some debt and cash, to come up with the pro forma combined company. That helps you have a model that does that. And then there's an area of, we're going to be financing an energy-related structure. We're going to do I think it's an oil rig. We're going to build an oil rig in the ocean, and you need the financing for that. And then you have a distressed bankruptcy restructuring area, another area that I have. Project finance, leasing, many cases in that discipline. So depends on what you do, there's a lot of that. It even has an equity model that calculates the return on the equity, like a DCF analysis, discounted cash flow, which we use all the time for valuation of companies. It has a DCF, beautiful DCF, I may ask. It's a one-pager, very beautiful. Actually, it's so beautiful you can actually frame it because it's all lines, it's perfection. So it's a lot of kind of things that you're going to use, believe it or not, you might use in your careers, even if the bank already has those tools to give you. It's a good way to create on your own so you have a little understanding how everything works.
Yeah, I mean, I like the one of the chapters, I think it's chapter 13,
Yes.
where you talk about enterprise value.
Yes, yes.
Right? Where you have 8 methodologies.
Yes.
So they're all there.
Yes. So the enterprise value, which we think it doesn't belong to the credit, it does actually. Because enterprise value, which I show 8 methods of calculating enterprise value, They have, from the 8, you got the 5 of them are market-driven methodologies, EBITDA multiples and everything else. And then you have the income-driven methodology, which is a DCF analysis. And I created the LBO analysis from a private equity perspective. If I have financial engineering, the right debt, and the right equity, I can create a higher return. And then you get into the so-called distress valuation analysis, which we use the good old-fashioned Black-Scholes option pricing. And Black-Scholes, if you don't know about it, Black-Scholes was created it's more like a probability structure to predict how the stock is going to move in the future. So if you are in a distressed situation, which I call it out of the money call option, you are distressed, how to come out of it with flying colors. So you use the option approach to value the structure that an airline will come out of it, after they structure the deal. So those are the 8 methods I go into very detail, and I do have a little case studies. And one of the spreadsheets, many spreadsheets actually, deal with the enterprise valuation methodology.
And that capacity was also very important.
And the debt capacity too.
Yeah. Can you explain that?
Yeah, debt capacity is basically what it says. How much debt can I put on this company? There are 3 areas that this is actually very revolutionary stuff, by the way. There are 3 ways to look at the capacity. The good old fashioned, actually, let's say you go and buy a house and you're going to try to get a mortgage. The banks look at 2 things, right? They look at your income. Can you afford to pay the mortgage? So they ask you for your income, what kind of money you're making. Of course, I'm not going to buy $1 million home if I'm making $50,000 a year. There's no way you can do it. So the income versus debt is very important. And in the corporate world, they look at that relationship. How much cash flow the company has, and they repay back the debt. So that creates the debt capacity. How much cash in the future if I present value back. The second one is the collateral. Is the secondary, how much assets you have. So if you buy a house, they're not going to give you 100% of the value. You're going to say, okay, you got to put 20% down, and I'm going to give you 80%. So the loan to value concept also works that way. And then the third one, I guess, is just a pure market enterprise value concept. So those are the debt capacity that we're looking for. Every bank has to do a debt capacity. Every institution, every company has maximum debt you can put it. And that depends on the industry that they have, based on the company itself, firm specific, market specific, and everything else.
So that's what makes markets disciplined companies.
Yes, exactly.
They have to stay within the norms.
Yes.
That's a good segue to saying thank you so much for coming here. Thank you, Chris.
Thank you.
Congratulations on your book.
Thanks, sir.
And thank you for doing this.
Thank you.